This is Shireesha from Master of Business Administration, Institute of Aeronautical Engineering. So, in this session, we are going to discuss about capital and its significance. So, let's move on with the term capital. So, let's discuss what is capital in fact. So, capital means it is a source of finance across all the types of businesses where like the amount of money which is invested in the business, right? So here it is generally we call capital as an investment. Okay, so capital means it can be some amount of money or worth of money, so which is in terms of monetary value. Okay, so for example we can take like few if an investor want to invest some amount of money in the business, so let us say he's getting 10 crores of cash into the business. Okay, so this is this is one part, and he also have a building or some kind of equipment or furniture in his building which is used for the business purpose. So the worth of that building and worth of the furniture and worth of whatever things which are there in that building all together is going to be validated for the amount of 1 crore rupees, let us say. Then that 1 crore rupees worth of that building or material or furniture, whatever it may be, that is also the capital which belongs to the business. So here the amount of money is the amount of money which is in physical cash, that is 10 crores, and the building which the investor wants to invest or wants to start the business, that building is costing 1 crore rupees. So this 1 crore worth of building as well as the cash 10 crores put together, total 11 crores is the capital now. Okay, so now it can be a form of cash, or it can be land, it can be building, it can be some fixed assets like furniture, plant, machinery. All these can also be bought as a capital when we start a business. So this is what is capital. So businesses raise capital by issuing stocks and bonds to the investors who are going to purchase the financial instruments with cash or some other assets. So what is the stock and what is this bonds and all? So one must know what is the stock. Stock can be like shares. So what is this share? Share means it is a unit of capital. We divide the whole lump sum amount into small parts, which we call it as a unit of the capital. Okay, one part of the capital which we call it as one unit. That unit of capital is called as share. Okay, so we generally call shares as stock. Okay, so if I'm a middle class person, what I wanted to do is I want to invest in small company. So apart from my savings, out of my savings, whatever savings I am doing, so with that savings, I wanted to invest on some company rather than depositing some fixed deposits on my name or on my children's name. What I'm doing is I'm just investing on a company. So when I wanted to invest some amount of money in any of the company out of my interest, so I am going to share some amount of capital to that particular company. Okay, so for example, XYZ company, I am interested in investing that. Okay, so when I'm interested to invest on that, I am going to purchase some units of the capital which is called as share. Okay, so that company is going to issue some shares to the outsiders, to the investors. So investors can purchase that particular share, and they are going to contribute the capital to that particular XYZ company. Okay, so this is how the through stock and bonds also, like capital can be raised for any of the business. So uh, the next like a definition or meaning of the capital can be like this, where the most crucial component of starting a business is capital. So it is the basic foundation of the capital. Until unless there is no capital, there is no businesses at all. So here there are two sources of raising capital, that is through equity and through debt. So basically these are the two sources to give the to raise the capital. Okay, so debt, what is this debt? Debt means it is kind of loan, right? So by borrowing some amount of money on the name of that business, a business is going to, or a company is going to take some loans from banks, from outsiders, from friends, or from like relatives. So from wherever chances are there to take the loans, it can take. That is what is debt. So through debt, the amount of capital can be raised, or through equity. Equity means just as I discussed, like through shares and bonds. So through shares also, they can company can raise the capital. So this is just a capital. So what is the importance of capital? How significant is the capital in the business? Let's understand now. So first of all, with this capital, what a company is going to do, that is what we are going to know now. So here, provision, capital is going to become a provision for tools and machines. Okay, tools and machines means, like, until unless we are not going to have any amount of money or worth of money in the business, one cannot start the business itself, right? So here, for that purpose, what like business, what investor, or what owner of that particular business is doing is, first he'll acquire the amount of capital. Once he acquires the capital, then only he starts spending the capital to shape out his business. So for that, what he need to do, if a person has started or if a owner has started a business, like a kind of business of production business, then what he require? So he requires some machinery, he requires some tools, he requires some equipment and all, right? So for that, what we require capital, right? So here, for like capital is going to be a provision for tools and machinery. And the next one is, for the continuous production, we require capital. Yes, for continuous production means, like for acquiring raw material, we require capital, we require money, right? So when we require money, we require we when we require money, we need to continue our business, right? So to continue our business, we require money, right? So when we have money, we can buy raw materials, we can pay salaries to the labor, or we can pay any expenditure which is there in the business activity. And this is also a provision for raw material. We require raw material, right? So we require capital to buy the raw material. And to increase the productivity and to increase the production also, we require capital. And for reduction of cost, this capital is going to reduce the cost of production. So here we already discussed a concept called factors of production, right? So what are the factors of production? Land, labor, capital, organization, and so sometimes technology also nowadays, right? So these are the factors of production. So this capital is going to reduce the cost of production. How it is going to reduce? So capital is one of the factor of production. So here the other factors of production are like land, labor. So what is the labor cost? Okay. So if you have some good amount of capital, you are going to pay the wages to the laborers, or you are going to pay skilled people with salaries, right? So if you are hiring skilled people, definitely they put more effort, or they give the efficient and strategic approach to go with the production process. So in this way, it is also reducing the cost of production. And the next one is it is going to create some employment opportunities to the people with this capital. And next one is it is the provision for subsistence, for existence also. This is going to be the provision of subsistence. Okay, so this is all about significance of capital. So now let's know what is the need of capital, why we require capital. So first, the basic point is, first, to start the business, to promote the business, we require capital, right? So until unless there is no capital, there is no idea of creating a business. Okay, so that's the reason first we need to promote the business. Okay, so to promote the business, we require capital. And the next one is, to conduct all the business operations smoothly, we require capital. So we definitely need some amount of money to conduct all the business activities, right? So here, when we have money, then only we can procure some raw material, then only we can do the production process. Like when we have capital, only we can hire some people and pay salaries. And until unless there is no machinery, one cannot go with production process. So we require capital everywhere, in every instance of the business, right? So that's the reason, like, this capital is going to be very, very useful in conducting all the business operations very smoothly. And not only just doing the current activities of the business, for expansion and diversification also we need capital. So already one business is already established. When the business is already established, now it has going in a successful way. Then how any owner of the business wants to diversify his business and expand his business, right? So for expansion and diversification also, one must require capital. And to meet contingencies also, we require capital for unforeseen situations, sometimes nowadays we are facing pandemic, right? So when we are facing pandemic, the owner of the business has to pay salaries, or has to pay wages to their employees or laborers who are working under his umbrella, right? So then only those families can survive in a better way. So this is a contingency where owner of the business should come forward and pay the salaries. But from where he is going to get money? From the capital only. Okay, so to meet that contingency also, he has to he requires capital, right? And to pay taxes, okay, one must pay tax also. Any business who is doing any business who is conducting the business operations, just, or it may be buying or selling, or it may be production, or it may be technological business, any kind of business has to pay taxes. So to pay tax also, one require capital. And to pay the dividends and to pay the interests to the investors also, we require capital. So what is this dividends? I hope you might have not aware of this dividend word. Okay, so dividend means, as I told, if a small investor wants to invest some amount of money in some company as shares. Okay, he is going to buy, a small investor is going to buy some amount of shares from the of some XYZ company. So why he is buying? Just simply he will not buy. Instead of buying shares, he can put it in fixed deposit or he can do some other activities. But he is investing his money, his savings in some XYZ company, right? Why he is investing? Because he is expecting some returns out of it. What are the returns? Returns can be dividends, like interest. If you lend some loan to your friend or to any outsider, what do you ask immediately? So, what is the percentage of interest you are offering to my amount of money which I am going to give to you? Definitely, we ask that, right? So, it is the interest amount, the percentage of interest, right? So when we lend a loan to some outsider, so we are asking them to pay some interest. Or if we deposit some amount of money in bank, then also what do we check? We definitely check what is the interest amount which we are going to earn on that lump sum amount, whatever we are going to deposit. So here, when comes to shares, so when I am investing or when someone invests in share, so he also expects some return out of it. So here, on the profit of like whatever that particular business on which I have invested my shares, that business is doing good and it has earned some good amount of profit. Okay, so when it has earned some good amount of profit, so that profit will be shared among all the shareholders, whoever invest on that. Okay, and apart from that, the particular business or that particular company is going to give interest on the shareholders fund, that is called as dividend. Okay, so to pay that also one must require capital. And sometimes after we use the assets like machinery or building or some vans or vehicles on the name of business, all these become obsolete, after 5 years of usage or after 10 years of usage. Do we think that the same machine can give the 100% productivity how it has given in the first year and after the 10th year? Definitely no, right? So here definitely it may have some repair issues, or sometimes there may be some breakdown in the machinery, or due to what? All because of its age, right? So after some time period, like the assets value will be getting reduced, right? So that's the reason it has to be replaced. But from where it has to be, why it has to be replaced, from where the money is going to come? Through capital. This assets can be replaced of the business, and this capital is required to promote the welfare activities of the business also. Okay, so what are the welfare activities a business or a company has to promote? Like giving some fringe benefits, or giving amount of money for their children's education, or making some insurance on the family of the employees, and giving flats or some XYZ benefits can be given. So from where these can be done? Through capital. Okay, and the last one, not only for promoting the business, conducting the business and making the business successful, also for winding up the business we require capital. So once the business has come to a position where it cannot be survived further in the market, then also the business has to be closed down. For closing down also one must require capital. So as a small investor, as a middle class person, I have invested on some XYZ company. So that company has went under losses, and that company has to pay some amount of money to me, because I have trusted that company and invested my savings in that, right? So even I am going to receive some amount of money. Through where? Through capital. So these are the like for everywhere, from every pin to big paper, we require capital in the business. So how a capital is structured, let's understand now. So this is first stage is senior debt. First stage is senior debt through like loans and terms, or through collateral tangible assets, or through like amortizations, and through convenient and guarantees by the founders. So through all these, debt can be raised. So debt means a business is going to take some amount of loan from the outsiders. So these can be the sources, what we can see. The second stage is like it is completely a positive cash flows. It requires positive cash flows, where here we can see long-term capital and with the limited and no amortization will be there. And here there will be flexible and customized convenience will be available in the second stage of debt. That is generally includes warrants, but is less diluted than equity. Okay. So the third stage is preferred equity. Preferred equity means here generally we include complicated provisions such as a liquidation, conversion, callability, and voting rights, long-term capital, and it is highly diluted, and long-term it is a it carries a dividend. So preference equity and the common equity. So let's understand what are these two, and why there is no amortization, and why there is amortization in the debts and all. Let's discuss now. Okay. So first of all, common equity means these common equity will be issued by any of the business as the owners of the business. Like we generally call it as equity shares. Okay. And the second, this stage we generally call it as a preference share. Okay. So what is the difference between equity share and a preference share? So for example, myself, I am investing on ABC company. When I have invested on ABC company, I am investing, I'm going to purchase equity stock. Okay. And my friend has purchased preference shares. So equity shareholder will have will have more risk when we compare with the preference shareholder. Okay. So here, equity shareholder is going to have higher risk when we compare with the preference shareholder. So equity shareholder is just he is going to be an owner of the business, but whereas preference shareholder is not the owner of the business. Okay. So here, sometimes these preference shareholders can buy the preference shares and they can convert it into equity shareholders later on date. Okay. That provision is there. And coming to equity, they are the whole and sole responsible person. Like if there is loss, the loss will be distributed among all the equity shareholders. And if there is huge profits, of course, profits are also enjoyed by the equity shareholders. And when it comes to preference shareholders, we are going to have some fixed amount of shares. So only that amount they are going to enjoy. Okay. So of course, through equity or through preference, the capital can be raised and a capital can be structured. So this is how a structure frame we can see for any of the business. This is how the capital is going to be structured. And next one is, what are the factors which are affecting the capital structure? So what is the business, what kind of business, and what is the risk involved in that business? So based on the risk involved in that business, a capital can be structured. Okay. And what is the tax exposure for that company? So based on tax, like if you take a sole proprietorship, Okay, so he need not worry about much about the tax. Okay, of course that is also business. Or we take a big business like a private limited company. Okay, when it is a private limited company, so he need to pay more tax, corporate tax and all. But when we compare a sole tradership, he is not going to pay much amount, right? So here, how the capital for sole proprietor, how much of capital he require hardly some in 1 or 2 lakh rupees he can start his business, right? Or hardly 5 lakh rupees. But when we go with a private limited company, then what is the capital we require? We require some crores of money, right? So that crores of money, like for that, what is the tax? Okay, if it is corporate tax, like how a capital can be structured. Okay, so here, like based on the tax exposure of the company, also a capital will be structured. And what is the flexibility for the financial assets, or what is the financial flexibility available for that particular business? Based on that also our capital is going to be structured. How the management is going to take over that business. Okay, so what is the style of the management? How what is the leadership of that management? What are the strategies a management is going to adopt to run the business? So based on the management style also a capital is going to be structured. And what is the growth rate? So there is any growth rate for the business, whether there is increase in the business, or it is going to saturate at a certain point, or where the business is going to decline, where the business is going to saturate. All these, based on all these points also, the company is going to be structured. And what is the market condition of that particular business, whether it is doing good or doing bad, or doing somewhat okay or average, or it is doing extraordinary. Based on this also, whether like for that particular industry also, we one must focus before a capital is going to be structured. And what is the cost of fixed assets, like how much of amount of fixed assets available. So based on fixed assets also, a business is going to be structured. And what is the size of that business organization? Based on the size of the business organization, like if it is a small, as I was telling, like if it is a sole proprietorship, we require only 5 lakh rupees to start a small petty business, right? So if it is like a limited company or a public limited company, then so it is going to be in crores of money, worth in it is in crores of rupees, right? So then obviously the capital structure is going to basically depend on the size of the business organization, and what type of business organization one is going to create. So based on the nature of the business also, a capital is going to be structured. So this is all about the simple introduction of the capital. Next session, let's meet to know about the types of capital. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.